How is Chipotle going to lift itself out of its sales slump? Hello and welcome to The Week in Restaurants, a look at the most important stories of the week in the restaurant industry. I'm Jonathan Mays, Editor-in-Chief of Restaurant Business, and I am here with Executive Editor Lisa Jennings. Chipotle just finished its worst year in a decade. Lisa and I will diagnose what ails the chain. Yum Brands reported earnings this week, and I have a few things to say about all of it. Later on in Tech Check, Senior Tech Editor Joe Guszkowski talks vibe coding, whatever the hell that is. But first, Lisa, have you been to Subway lately?
You know, I haven't been to Subway lately, but I hear that they're having some issues.
Well, so you're the problem. You haven't been going to Subway enough is the issue, Lisa.
That seems to be the problem, yeah.
Anyway, they a 43-unit Subway franchisee filed for bankruptcy. Company named MTF Enterprises. In and of itself, the fact that a Subway franchisee would have financial problems, not remotely news, because a lot of them are, which is what happens when you have a brand. It closes roughly about, I think, somewhere in the neighborhood of 700 to 800 locations a year, going back for a decade. So this is in and of itself nothing new. What's notable about this one, Lisa, is that they used merchant cash advance financing. Which is now, I don't hear about this that often.
Well, why don't you explain what this is, Jonathan? Explain what an MCA is.
An MCA is when you get cash now, and they will take a percentage of your credit card receipts as payment, and they will take them daily or weekly, really depending on the setup. The interest rates on those advances are ridiculous. And the Subway situation, they were paying two MCA companies interest rates, one over, I think, somewhere in the neighborhood of 56, 57%, the other one 90-some%, which is astounding interest rates. And we've been hearing this now a few times. There was a Del Taco franchisee last year that ended up in bankruptcy because of MCA financing. And then Fat Brands took out some MCAs with its cash situation. But, honestly, what this is a symptom of is the broader issue where we have a restaurant industry that has now been dealing with a couple of years of weak sales and traffic. We have high, costs are higher than they were, obviously, a few years ago. And, valuations in the restaurant industry are not what they were. We have a number of restaurant chains out there that have had various issues dating back years. Subway, sort of exhibit 1A on that. They've had issues going back a decade. You have franchisees closing locations very frequently, and you've got a lot of lenders that just won't lend money into the system now. And, franchisees don't have any option if they need cash. And then they turn to MCAs,
right?
Which, if you just exacerbates a cash flow problem. If you have a cash flow problem, you should not be taking out MCA financing unless you know something is coming. Like, MCAs are, they do play a role in society. Some people and businesses do need cash on a short-term basis.
Seems like a last resort sort of thing.
It is an absolute last resort. And it's just super, super dangerous financing, whether you're an individual or a business. And unless you have some sort of, you have some money coming, that's where, and money over and above what your normal, day-to-day revenue is, then it's just not really something companies should take out. You need to figure something else out. But honestly, in many respects, this is kind of where a lot of companies are,
right.
Because they don't have any other option. And, in many, they need to pay their bills. But I think that essentially what this is telling me, Lisa, is we just have a lot of restaurant companies that are, and franchisees and restaurant operators that are having some real issues right now.
Right. Right. Yeah. No, I mean, it seems, I feel like this year we're going to be seeing more of this. It really comes down to, consumers changing their habits, and, the restaurants companies that are doing in trouble now, that are in hot water now, are just going to find themselves, falling deeper and deeper. So it might be a rough year for a lot of folks out there, I think.
Yeah. And one last point about Subway. Subway has relied very heavily for a long time on discount marketing to get customers in the door, the $5 footlong. And then they've been trying to do something since then to resonate with consumers and generate traffic, because they have so many stores that they need a lot of customers to fill those stores, and haven't really been able to do that consistently enough without some kind of discount. So now they also have their sub club has returned, and they designed it in a way that they give away more. More, I think you get more for your purchases with the sub club than literally any other restaurant chain on the planet. And a lot of franchisees, not all of them certainly, but a good number of them have been pushing back on it, and kind of use that kind of as a symbol of some of their challenges. So if you have a high discount rate with low unit volumes that Subway has, and you already are dealing with, generally weak sales and a tough environment.
But whatever went wrong with this bankruptcy, the franchisee that you just mentioned, it probably was going wrong long before Sub Club came into the picture.
Oh,
so
yeah.
It's not related at all to Sub Club being introduced.
No, it's not. Yeah, that is 100%. The Sub Club had absolutely nothing to do with this bankruptcy. Essentially, what we know is that it was a lot of weak stores that the operator bought up at low prices and then continued to be weak stores after they were acquired. And then at some point, you just don't have any choice. But speaking of weak sales, Lisa, what's going on with Chipotle?
Well, they ended the year on kind of a sour note, but Scott Boatwright, the CEO, still really feels that they have a plan for turning things around. We'll see, whether or not consumers will change their ways. But they, for the year, Chipotle was down. The same store sales were down 1.7%, and that included about a 2.9, nearly 3% decrease in traffic. And that was the first time, really since 2016, that they've had a full year negative same store sales decline. And, it indicates there's a problem there. And I think it's a problem that is affecting a lot of fast casuals. It's not just Chipotle, but I think Chipotle, is still really in a position where they need to focus on their value perception. Scott really feels that the protein thing is resonating. So they're getting back some of those younger guests. Now they're kind of focusing, he's pointing out that a good 60% of their consumers make more than $100,000 a year. And so they're kind of focusing their marketing more on them, really, again, pounding home this better quality, better ingredients message that has always been true about Chipotle, but they're really trying to emphasize that now, that if you're paying a little more for fast casual, you're getting something better, is the message, better than fast food anyway. And so, that's it. We'll see whether or not this year, if you remember last year, they started out the year, saying that same store sales would be up for the year. And first they said single digits to mid digits. And then they went down throughout the year. They downgraded 3 times. This year, they're starting out much more conservatively and saying it's going to be flat this year at best. And so we'll see if they can do better than that. But, flat is the new up, I guess. Anyway,
in Chipotle's defense, Lisa, they're really not used to this. They're really not used to this.
They've
Other
been
companies
riding high for a while.
Used to this. Chipotle is not.
Yeah.
They've last year, I would actually argue, was their worst year since they became a public company. In many respects. Now, you can't really say it's the worst year, because that is definitely 2016. But that was also, we had a reason
Food
in
safety
2016 why they had to.
Yeah.
We have no idea why Chipotle is having these issues. We have only vague ideas. And I've had a lot of people asking me over the past year, really since that first quarter, or that I guess, yeah, that first quarter last year. I've had a lot of people asking me, what's wrong with Chipotle? Is this systemic? And I'm just like, it shouldn't be, because it isn't. They have on a calories per dollar spent, they're arguably the best value in fast food. They do have a quality reputation. Their menu is infinitely customizable. You can do any number of things with it. You can make a giant, highly caloric burrito, or you can have something a lot healthier with, or you can just load up on protein. You can just have beans and rice, whatever. Everything works well together. Their food is delicious and things of that nature. And so we're really kind of stuck with this idea. Maybe it's a marketing issue. It might go back to I still think a significant portion of this goes to the idea, goes back to the issue of portion sizes.
Well, it's interesting that you say that, Jonathan, because, one of the things that Scott talked about this week is that they're actually finding that the lower priced items that they had on their protein menu. So they have a taco, which they've always had a taco, but they're promoting how many grams of protein is in it. And it's only $3.50. And then also this new chicken cup, this cup of chicken chunks.
A cup of meat.
Cup of chicken.
We are now, I'm sorry, not to interrupt you, Lisa, but we are now at the cup of meat portion of this dumb protein trend.
Yeah. So, but it's $3.80, and these entry points apparently are bringing people in. And so Scott is saying that it's not, that he's seeing actually that there isn't, with the GLP-1 drugs that we have people like me who eat like a bird, Jonathan, as you always point out.
A bird, yes, a small bird, not a big one either, not a.
Right. But the point is there's a loud vocal, I'm minority, majority, I'm not sure who wanted larger portions at Chipotle. And so Chipotle really took a hit for that. They brought in all these larger portions, but I think now they're realizing that people want choices. There are some people that want lower priced items that bring them into the menu in a way that they can afford. And it really has addressed, he thinks, their value perception. So we might see more of that. They're going to be bringing more to the menu this year and marketing that more heavily. And some of the things that they're going to bring are going to be some handheld sides that are more affordable and smaller portion things. And I think that's terrific and a very smart idea. I had a conversation just the other day with a young couple in their 20s. We were talking about Chipotle. Young man said he goes after the gym. He thinks it's great. And, also mentioned that the stores have been dirty lately and things have been seeming a little messy. But I said, has that stopped you from going? He said, no. And then he said he always picks up something for his girlfriend, and his girlfriend always gets a kid's meal, because she doesn't want the big bowl like me. But a kid's meal, I don't know. I just feel like there's such an opportunity for restaurants here to do something that is smaller, like Olive Garden is doing, smaller portions. Same thing, but smaller portions of it. And you can get better margins. Anyway, that's a whole nother conversation. But
that's a whole nother conversation. It was more about the portion sizes that they give you when you order your full price meal.
Right. So people want what they want is big scoops of meat. Or
people want to get what they pay for. It goes back to this issue of how consumers think of as value.
Right.
And Chipotle is fundamentally a really good value, but if consumers think they're being skimped, they hate it. They don't like it at all. And that's just my guess, because I would have thought that it would have had an earlier impact on them than it actually did. And so I have absolutely no idea. Sometimes I think, going back to the dirty restaurant, you mentioned the restaurants. One of my issues with Chipotle, and I love the food, by the way, don't get me wrong, but eating at a Chipotle is like eating in a bus station, right? And some, with all the ambiance of waiting for a damn Greyhound. The chairs are uncomfortable. A lot of times it is dirty. I don't know. I've never, but I don't know if that's it. They've always been like that. So why would this now be? Why would this be an issue now?
Yeah. Well, they're really focusing on, they have long focused on their digital sales and to-go business. It's all about convenience. And that's what a lot of their customers are looking for. So, they're in the process of rolling out this new kitchen equipment, which apparently has really been impacting, showing some, measurable impact on their throughput and same store sales. And they hope to have it in 2,000 units by the end of this year, which could make a difference. And then, hopefully they'll speed the rest of their 4,000 units now, over 4,000 units. So that's something that shows promise in changing things a little bit. But fundamentally, I think it does have to do just with that value perception and people, being able to afford going out to eat as much as they did before. And I think we're going to see it across fast casual. I don't think it's just going to be Chipotle.
No. Yeah, no. No, I will say, going back to the smaller portions issue, it's definitely something that is an opportunity for restaurants, with GLP-1s coming in and protein and stuff like that. You're going to, it's actually in many respects a great opportunity because you're going to be able to, get a higher margin.
Right. I feel like it's a no-brainer, but there's probably operationally a lot of challenges to it, I suppose. But I think there is a market for this out there, and I think there are people out there who would choose a brand that had a good smaller portion option. I would. Of
course you would, because you eat like a hummingbird, not a harpy eagle. By the way, you eat like a hummingbird.
Birds do eat a lot, but yes,
that's right. Well, but anyway, all right. I need to talk about Yum Brands earnings. Because there was a lot there.
Yes.
And Pizza Hut. The big news came from Pizza Hut, which is closing 250 locations, joining a pretty long list of restaurant chains, major restaurant chains. They're closing a lot of units. So we had Starbucks, Wendy's for the second straight year, Jack in the Box for, I think, again.
Noodles and Company.
Noodles and Company. We have a long list of companies, many of which filed for bankruptcy, most of which did not. Many of which are just using this as an opportunity to reset. With Pizza Hut, the 250 units that are being closed obviously are franchisee locations that are underperforming, and it's part of an agreement. This is a very vague agreement. We don't have any details about what this agreement is, which means that the investments that Yum Brands is making in this part of this deal are not significant enough that they have to report it. So if it was material, like if it was 150 million or something like that, they would have to report it because it would be considered material. But they didn't. They're saying that they're making investments in marketing. We do not know how much of those investments they're making. And then they said that it's an agreement with franchisees. Those franchisees have agreed to changes in the franchise agreement. So we have to assume that it might be something on the royalty front or the Mad Fund front or something along those lines. They also making adding technology to the restaurants. They call this a bridge to a longer term solution because Pizza Hut is on the market, which the company is evaluating strategic alternatives. And my read into this is that they're having a tough time finding somebody who is willing to buy the chain, or at least at a price that they consider it worth it. And that kind of would follow the Papa John's situation. Papa John's had been spent pretty much all of 2025 dealing with, unsolicited offers of acquisitions by a couple of different entities, and it did not result in a deal, which means that in fact, I think the last one was just flat out pulled off the table from Apollo, which means that there's some concern really about the state of, to me, this is kind of the situation in the pizza sector right now, which the pizza sector is facing some existential challenges. Much of it is rooted in third-party delivery. So you have a third-party, back in the day, Lisa, and not that long ago, for most of our lives, if you wanted a delivered meal, you would get pizza.
Pizza, yeah.
You could get Chinese in many places. Like in my neighborhood, we have a wonderful Chinese place that has done delivery historically. But that's it. Most of America, it was pizza and maybe Chinese. Unless you're, and now that third-party delivery has come around and is enormously popular, more popular than I actually had predicted. I figured that eventually that somebody would figure it out. They did because there was demand for it. But the popularity of third-party delivery has continued, even in the face of a restaurant market that's generally really weak. So you have now, if me and you want, or anybody else wants a delivered meal, we can get anything we want. We don't have to just get pizza.
Right.
That's significant. And pizza, now all these pizza chains are now on third-party delivery apps, mostly as a marketing tool. But they're not going to replicate the sales that they're losing. Simply because they no longer have a veritable monopoly on prepared food delivery. And so that's a significant challenge. And, pizza is available everywhere, so you maybe don't want pizza. You can get a delivered meal and you're willing to pay a few bucks. You can get something else. So that's a significant challenge for these businesses, and many of which built their business around this concept of delivery. That and Pizza Hut was a big one. They changed their entire business model over the years, which I talked about recently. So to get this market, they changed their entire business model, spent a lot of money. I think in hindsight, it wasn't necessarily worth it.
Moving from the red roof model.
Yeah. I look, they made their decisions for very good reasons. Or, dine-in service, full service restaurants have had challenges going back a long time. We don't really eat pizza in restaurants anymore, like we used to. And so the dine-in pizza business, you got California Pizza Kitchen, companies like Giordano's and concepts like that, local concepts, have all been sort of challenged historically. So there's a good reason why Pizza Hut would make a move like that. So, but really kind of a tough situation for them.
I would also argue that the pizza space, and I think we've talked about this before, has suffered from competition with, there in any city now, there is just so many local, really good pizza shops that are, produce a better quality pizza than you can get from a lot of these big chains that are out there that, typically the delivery chains, and not at a different price point. And you have grocery stores and Costco and, my Whole Foods, I live very close to a Whole Foods. They make a pretty darn good pizza that you can just walk up there. It's ready in 10 minutes. You take it home. And it's, I feel like that cuts into the business even more probably than obviously you can order anything for delivery. And if you're going to get something delivered, that's, the world is your oyster now. But I think there's really good pizza out there that's locally made and better than the chains are doing.
Well, and then if you can order it with delivery, just makes it that much more competitive.
Right.
What Domino's has done the past couple of years is actually very impressive given the market. So you also have Domino's that is smartly, as it turns out, focused on carryout. That carryout business really tailored their stores for those customers, and then built a lot more locations. So they've been grabbing a ton of market share over the past few years, getting increasingly dominant. And, Little Caesars is doing pretty well. I don't mean to trash the entire sector. Little Caesars has been doing okay during this entire time, but Papa John's and Pizza Hut have had challenges, and then just the broader market. If you look at total pizza sales last year, they were very weak, less than 1% total growth, the total chain universe, which is actually ridiculous.
Yeah.
So it's tough. Now I also need to get to Habit Burger real quick.
Okay.
I have something to say about Habit. You're familiar with Habit, are you not?
I'm a big fan of Habit Burger. I think it's
Habit. Habit is a phenomenal menu. They have the green beans, don't they?
Yeah, the fried green beans. Yeah, I think they do.
Fried green beans. Oh, those are amazing.
Yeah,
absolutely. One of the best sides in the restaurant business, without a doubt. Yum Brands bought these guys in 2020 during the pandemic. And right now, if you listen to their earnings calls, if all you did was listen to Yum Brands earnings calls, and this has now gone on 2 straight calls, you would barely know Habit was even part of the company. They mentioned it once in those 2 calls. Coincidentally, since the retirement of David Gibbs. And the one time they mentioned it was just in passing. It was like, yeah, Yum Brands, the owner of KFC, Taco Bell, Pizza Hut, and Habit. But this week, they didn't mention them at all. And the reason is, if you take a look at their system sales, they've really slowed down. So they were up in the neighborhood of about 12% post-pandemic. Like you get 2020, they were down, and then 2021, they were up big. So you can't really, you got to take those with a grain of salt. And then you get to 22, they were up 12%. And you're like, okay. And then the number in the system sales growth number has slowed markedly. And last year was just 1%.
But it was up.
Well, sure. System sales. This is system sales.
Okay. Yeah.
Not, this is unit growth,
right.
and same store sales.
Yep.
And a lot of franchise brands, by the way, and probably rightly, think that is the metric you should judge a brand's performance on, is system sales. Yum Brands bought Habit for the explicit reason of getting growth in the US.
Right.
It is now 5 years, actually going on 6 years since this acquisition. And they're now just getting 1% system sales growth a year from their growth chain acquisition. Why they didn't mention it, who knows, it could be anything, any number of things. Are just not, it's not really what investors in Yum Brands don't even think about Habit, because it doesn't move the needle. It is a fraction, is a tiny compared to the other three restaurant chains, which is part of the problem. My problem with this is that, these large companies decide, a chief executive gets a whim and says, oh, we're going to buy this growth chain. It's really, really, really difficult for a owner of large scale chains to operate small growth concepts. They are two different things. Big chains, you're kind of maintenance. You are effectively, it is just much more complicated to operate a big chain. With a growth chain, there's just a different mindset, It's better in many respects. And maybe this is what they're doing. Just just kind of don't talk about it much and let Habit just fly under the radar. You just give Habit the support they need. And if that's what they're doing, that's actually a really good idea. You give Habit the support they need, and then you try to keep them out of the limelight. But my concern with these things is that when you get these large companies that use some of their extra cash to buy these small growth chains on this idea that this is going to provide them growth. They'll sell Habit restaurants to existing franchisees. Those existing franchisees will grow a bunch of units, and then Bob's your uncle. We saw this, I think, with Applebee's and IHOP buying Fuzzy's Taco Shop, and then Fuzzy's almost immediately declined. It's not quite on the same scale, but it's a similar situation.
Yeah.
The problem is that these companies can get lost. These growth chains can get lost with all of these big companies, because all the attention is being focused on Taco Bell fixing KFC in the United States, figuring out what to do with Pizza Hut, or in Applebee's case, figuring Applebee's, and then IHOP. You don't necessarily focus as much attention on the growth chain. Maybe you do, but oftentimes you don't. The companies don't quite get the attention that they deserve or need, and then their performance lags, and then the company will just offload it. And
Habit is I would describe it more as a fast casual brand too. It's not as much a QSR brand as the others in the family, but it's kind of a hybrid. It's really on the border. They've made it a little bit more, emphasizing the drive-through before the sale. I think that happened, but it's a good brand. It's a strong brand, and you've written about better burger brands actually doing pretty well last year. Relatively, and including Shake Shack, and Habit was one of them that seemed like it was doing okay.
Yeah, I thought that they were, they had some same sort of sales growth in the third quarter. It kind of fell to flat in the fourth quarter of last year. But, again, there's no real mention of it. Again, there's no penalty. The problem is there's no penalty for Yum Brands or its executives if this doesn't work, because it was practically spare change for them when they bought the company, and whatever loss that they take off of the deal, again, spare change, and investors they just wouldn't even care. So there's no real penalty for this thing. And in some respects, that's a good thing, right? You want you do want executives to you to take risks and do cool things and that sort of thing. But at the same time, it's like, why? That's the question. Like, why buy it?
Just offering that option to the franchisees? Is it more just a franchisee, supportive move that it just gives them something else to be able to?
I mean, in theory, that's, they give their franchisees something else. But I mean, look, if you're opening a giant, if you own a bunch of Taco Bells, first of all, you're doing great. You have a super valuable group of restaurants because Taco Bell continues to kill it over and over and over and over and over again. And you're getting really high margins now. They do almost 25% operating margins on Taco Bell. It's actually really impressive for that sector.
Yeah.
So you don't have any real reason. I mean, like I know a bunch of Taco Bell franchisees are happy as hell. They just love Taco Bell. And of course they do, because it's great. See, why would you buy Habit? And if you're a KFC franchisee, you're just trying to make sure your KFCs are surviving. Maybe you might, and some of these guys will and have been more likely to invest in some of these growth chains. But like, look at Greg Flynn. Look at what he did. He went and bought 7 Brew. Some of these big franchisees get their pick of the litter. So, I mean, they can and do and stuff like that. In any event, I don't know what the deal with Habit is. That's basically my thing, Lisa. So later on in the podcast, Joe Guszkowski talks about vibe something or another. I can't remember what is a vibe coding. Good grief. There are more terms that come up every single day, and I have no idea what they mean. Lisa, I'm getting old. Anyway, but coming up first, you will have some sort of ad from Spoons. Restaurant operators, are you ready to lead the future of food service? Join us at the Restaurant Leadership Conference happening April 19th through 22nd, 2026 in beautiful Phoenix, Arizona. At RLC, you'll connect with the top industry leaders, gain insights from iconic speakers, and discover the strategies and tools to take your business to the next level. This year, we're celebrating 25 years of innovation and leadership, making it our biggest and best event yet. Don't just keep up with the future, lead it at RLC 2026. Learn more and register now via the link in the description.
Hello and welcome to Tech Check, where I, Joe Guszkowski, talk really fast about one big topic in restaurant tech. This week, restaurant tech in the age of vibe coding. I recently talked to Noah Marbach, the founder of XShift, an AI-powered scheduling assistant for restaurant managers. It's basically a chatbot that can spit out a schedule in minutes, but the most interesting thing about it is Marbach himself. He's 18, a senior in high school, and he created XShift largely with the help of an AI coding program called Claude Code. He has a basic understanding of coding, but Claude did most of the heavy lifting. This process, known as vibe coding, has lowered the barrier of entry into the software market. Y Combinator, the big startup incubator, said last year that a quarter of its class was almost entirely vibe coded. This raises some questions for restaurants. There's already probably too much tech on the market, and adding more new products from inexperienced developers is likely to create more noise and confusion. On the other hand, vibe coding could lead to useful and innovative products from folks outside the norm, like Marbach. It's hard to say how successful his company will be or even whether it's any good, but it's another example of how AI is changing just about everything we took for granted about restaurant tech.
And that should do it for The Week in Restaurants, which was edited, as always, by Spoons. You can find this and other episodes of the podcast on our website at restaurantbusinessonline.com, but please subscribe on Apple Podcasts or Spotify. I'm Jonathan Mays for Lisa Jennings. Thank you for listening.